So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to be answering the question that has to do with short selling basics and how you can sell stock that you don't even own. So when people start trading options and start trading stocks, they undoubtedly run across the concept of going short or short selling. And so it's really confusing at first because the idea is, well, how do I sell something that I don't even own? And that'd be like selling a car without even having a car. How do you do this, right? Well, the concept is actually really easy, and I'll try to explain it very simply for you guys here today on the show because I want you to understand just the basics of it. We're not going to get into the nitty-gritty and the actual behind the scenes of who's doing what, but just the basic concept of how short selling works is actually really easy. So if you think about option buying or stock buying, just to use the other side of it here real quickly, you would buy shares in the open market, and then to complete your trade, to close the trading loop, you have to sell those shares at some point, right? So if you buy shares and then you outlay money, you have to then sell those shares in the open market to get back the money that you had invested or money you invested with profits, right? There's no other way to do it. To complete the entire trading loop and close the position, you've got to sell what you bought originally. Well, in short selling, it works in the total inverse. So when you sell something short, you're basically borrowing shares from the broker or the market and selling them in the open market to somebody else. The idea is that when you sell those shares, you're hoping that they go down in value so that when you close the trading loop and you buy back those shares, you buy them back for a lower price than what you sold them to somebody else. So it's the same concept, it's just taken from the other side. Now, the difficulty in selling stock short is just having the availability of shares to borrow from the brokerage or from the company to be able to sell short stock, right? Because you have to borrow shares and sell them to somebody else, hopefully closing the trading loop by buying back the actual stock at a later date for a cheaper price. So this is a way that you can actually speculate or hedge against a potential stock going down. That's what some people do a lot. In fact, you hear a lot of these terms called short squeezes and short interest on the stock, and we'll talk about all of those in future shows. But just this idea is actually very easy, is that you don't own the stock, you're kind of borrowing it, and you do have to complete the trading loop, right? You have to at some point buy back the stock, hopefully at a lower price, but it could potentially be at a higher price. So here's a really good analogy that I've used before in coaching and some of our training, which I think might help even drive home this point even more. And that's the idea of a home builder. See, a home builder is actually somebody who is selling the home short. That's really what they're doing. They're a short seller of housing. So when a home builder comes up to you and they contract with, or you contract with them to build a home for say $100,000, well, that home builder has now sold you something that they don't even own yet, or they don't even have to give you, right? You've written an agreement and you say, you know what, Mr. Home Builder, I will pay you $100,000 to build my home. Well, the home builder hasn't done anything. They haven't built the home. They haven't, laid the foundation or built the walls yet. So they're selling short. They're borrowing basically future time and your agreement and money, hoping that they can actually build the home for less than $100,000, right? Because then that's how they make their money. They are contracted to only get $100,000. So if it costs them $110,000, he's got to go hire his own, people. He's got to spend time and gas and buy wood and, roofing and everything. If it costs him $110,000, well, he loses $10,000 on that. Now, that doesn't make him a bad guy for being a short seller of homes. It's just a really kind of, life example of how this works in the regular market. This happens all the time, all over the place. It's not that short selling happens just in the stock or the options market. So again, a home builder is a short seller of housing. They're selling you a house for $100,000. And if he can build it for $90,000 and you're happy with it, then he makes this $10,000 profit. He's hoping he can build it for less than the cost that he sold it to you for. So hopefully it helps out. As always, if you guys have questions, even as simple as the ones that we got here today from one of our members in an email, please let me know. Shoot me an email, send us a tweet, post on Facebook, whatever you have to do to get your question in here to the Daily Call. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.